Hello and welcome to episode 465 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, how are you doing?
I'm good. I'm absolutely buzzing because I've just read a review that we're about to read out for the podcast, and we received it just before we came on air. So if you've not reviewed the podcast, then please do make sure that you do review the podcast. 5 stars in the app of choice, wherever you listen to our show, because it does really help. And also, before we go on and read out the review, do remember to support the show. So do look at all of our socials. We're doing lots on socials. So there are parts of this podcast that are cut up and put out on social channels as video. So go to Instagram, TikTok, our YouTube channels. As ever, there are links in the notes of this show, so you can go through, follow us, but do make sure you like and share the posts that we put out all the time, because it does really help us. Also, don't forget our Facebook group, facebook.com/groups/money to the masses, because that's actually very active these days, and it's a really useful place to be able to go and ask questions and talk to other podcast listeners. So Andy, I'm going to hand over to you so you can read out this review. It's a brilliant review. It's a lengthy one, but it's well worth listening to.
Yeah, so the title of the review is Make a Decision That the Future You Will Thank You For. And it goes on to say, I'm a director of branded content and I was out filming around London for one of our clients who are a major household name insurance company, and we were asking people to think about what decisions they could make that their future you would thank them for. Several said that starting to invest or become more financially literate was the change that they needed to make, but they didn't know where to start. And after cutting the cameras, having been an avid listener for about 18 months, I was pleased to be able to confidently recommend that they listen to your podcast, saying that what a difference it had made, and it continues to make for me, having come in with little to no clue about money matters. So it goes on. It's a little bit more detailed than that, but that's the crux of it. And it really made a smile in the office.
It was a fantastic review, and because they are a real advocate, clearly, of our show, they will be getting a Money to the Masses mug. So the person who sent that in is Will, I think the name was. Is that right, Andy? If that is you, do email us in on the show, or you can message us directly on things like Instagram and claim your free Money to the Masses mug, because I'll be more than happy to send one out to you.
Okay, so let's get on with this week's show. Damien, what have we got coming up this week?
So, as ever, there are 3 pieces, but there's going to be a small 4th piece for those of you who watch this show on YouTube. We are trying to encourage more people to watch the show on YouTube, because if you go over there and interact and talk about the show or ask questions, then I am answering those. So please do go across to our YouTube channel and watch the show and leave comments, even if it is just for the algorithm, as some of you do. The 3 pieces on the podcast this week are in relation to getting on the property ladder. Now, there's loads of different schemes, but also ways of getting on the property ladder, so mortgages, etc. And I find it's quite mind-boggling. I do worry about people who are trying to get onto the property ladder. They may be overwhelmed. So I'm going to give a roundup of some of the ways that you can get on the property ladder, so it'll be useful for those people who are first-time buyers, but also for people who may know people in their family that are looking to get on the property ladder. They can share this part of the podcast with them. The second piece we're going to be doing is in relation to LayBuy. So the buy now, pay later company has gone into administration. What does it mean for customers? So we're going to be talking about that. And the third piece we're going to be doing is in relation to flight compensation. So there was an interesting event, not for the people involved, unfortunately, but Manchester Airport. There was a problem, a power cut, that meant that lots of flights were delayed and cancelled. So in a scenario, an unusual scenario like that, where it wasn't the airline that was actually causing the problem, it was the airport itself, what happens? What are your rights? We're going to go through that for you. And the 4th piece, if you want to know what that is, then go across to the YouTube channel and you'll be able to see that there.
Okay, so let's get on with the podcast then. And Damien, this first piece is about getting on the property ladder. Now, do continue to listen in if you have already got your property. This isn't really just targeting those people who haven't yet got their house. There's lots of schemes available, isn't there, Damien? And ways in which you can help to save deposits. You're going to do a run through for us.
Yeah, and like you say, Andy, I know there'll be people who think I've already got a house and they might skip forward. Fair enough, but it is likely that you'll come across somebody who you either know, family or friend, who's looking to get on the property ladder, and there may be something you hear now that you'd be able to say to them, did you realise there's a scheme available for you, or a certain product that's out there? Now I'm going to run through the various different schemes and products, and I'm not going to go through all the pros and cons of each. What we will do is, in the notes of this show, we'll put links to all of the different things that you can go and read in further detail. So do look at the notes of the show. So the way I'm going to tackle this is look at it from a problem and solution perspective. So first of all, the problem of a lack of deposit that some people face. I'm going to go through some possible solutions to that problem. I'm then going to look at the affordability problem. So there'll be people who struggle to meet affordability criteria, the possible solutions to that. And then I'm going to look at some of the government schemes that you may have heard of, or you might not have heard of, that can possibly help you. But let's look at the possible solutions for a lack of deposit. Now, one of those things is a guarantor mortgage. Now, this is generally aimed at people who have a low deposit or poor credit history. And the way it works is that you typically get a close family member, or somebody you've got obviously got a long-standing close relationship with, who's willing to put up some of their savings or equity in their home as collateral so you can secure a mortgage. Now, as long as you keep paying your mortgage payments, you can secure the mortgage without any impact on your guarantor's finances to a certain degree. Now, guarantors using the equity in their home usually have to have at least 50% of the equity in their home available or more. Now, there are some drawbacks. Obviously, guarantor mortgages have to be really thought about seriously, because if you don't pay your mortgage, ultimately, it could get to the point where the guarantor could end up having their property sold. So they could end up being liable for the money that you're not paying. So that is in the extreme, but it is a possibility. So it's something not to be entered into lightly. Now, the other solutions that are out there, there is one from Barclays called the Barclays Springboard Mortgage. You will have seen adverts for this actually on the TV. They're advertising it quite a lot. And it's a type of guarantor mortgage. And again, we'll put links in the notes of the show for this product. We've got a full review of it, and I think we've even covered it on the podcast in the past. And the way it works is a family member can put a deposit of 10% into the Barclays Helpful Start account, and it pays interest on the savings at 1.5% over the Bank of England base rate, and the money has to stay in there for 5 years. Now, the mortgage you get is based on 100% loan to value, so the interest rate is high at 5.8% currently, and the deposit and the interest that accrues will be released after 5 years. So what you're really doing is you are benefiting from the person who is ultimately locking money away, who's getting a return on that money, but locking their money away without access for 5 years, and you therefore can gain a mortgage and be able to buy a property. So that is another type of guarantor mortgage that people can look at. The Skipton track record mortgage is another interesting development. It's unique in the market because it doesn't require another party to guarantee the no deposit or low deposit mortgage, but the way it works is that it can be used by renters who can prove that they have successfully been paying rent that is equal to or greater than their prospective mortgage, and that has to be proven over a period of at least 12 consecutive months. Now, they will also have to be able to prove that they've been able to manage paying bills. Now, the mortgage rate is relatively high at 5.79% for a 5-year fix. So again, that's another option that's available to people out there. The other thing you can do if you've not been able to save up a significant deposit, lifetime ISAs can help you. Now, that is a government scheme that's available to people who are aged between 18 and 40. We'll put a link again in the notes of the show. Now, this is a scheme whereby you can put money into a lifetime ISA and the government will boost that by 25%. Now, what that means in reality is that you can put up to £4,000 into a lifetime ISA in a tax year, and the government will give you a £1,000 bonus. Now, there are caveats about the way the lifetime ISA can be used in terms of the value of the property that you can buy. There is a cap at the moment that is limiting its potential for people in areas like London, which is more expensive. Again, there are links in the notes of the show, but the lifetime ISA, you can get a cash version, so you can earn interest on your savings as well as get that government bonus, but also you can have an investment one, a stocks and shares lifetime ISA, which is an option. It is a vehicle that I think is really useful to people to try and increase their deposit. And also, if there are multiple people, say there is a couple who are trying to save for a house, then they can each have a lifetime ISA and they can each get that government bonus. So it's doubling up on that bonus. Now, I'm going to jump onto possible solutions if you can't meet affordability criteria and you're struggling with the rising house prices out there. Now, one option is obviously a joint purchase. So this is where you effectively club together with another person, maybe a parent even, to combine the power of your incomes to be able to meet affordability criteria. Now, typically, if you're a couple, you'll be buying a property jointly. Now, you will both own the property and be responsible for the mortgage. And if your parent already owns a property, if you're doing it with a parent, then that purchase will be subject to additional stamp duty. So do bear that in mind. Now, another option is going down the joint borrower and sole proprietor route, where that means that you can combine up to 4 incomes to support a mortgage application. Now, you can limit the ownership that the other people have, so they don't all have to be named on the land registry as the owner, but you are responsible, all of you, for the mortgage payments if there is any kind of default. Now, one advantage is that if a person is a joint borrower, but they're not actually on the deeds of the property, then it won't attract that additional stamp duty. So in the previous example I mentioned, if a parent already owns a property, you wouldn't encounter that problem with a joint borrower sole proprietary mortgage if they aren't on the deeds. Now, another option is a concessionary mortgage. Now, we'll link to the podcast episode that we covered this topic with Harvey, and a concessionary mortgage effectively allows you to buy a property below market value from, for example, a family member. So let's say there was a parent who wanted to sell the property to their child at a below market value. You can do that. The discount effectively works as a gift for inheritance tax purposes, so there is an inheritance tax liability. It does mean that because you are buying a property at a reduced value, there is less stamp duty to pay as well. So there are advantages to this. There are disadvantages to this. I mean, one of the advantages, it does mean you could potentially buy a property that would be out of reach. But we will put a link in the notes of the show because there are some distinct disadvantages of concessionary mortgages. Now, another option is a professional mortgage, which a lot of people don't know exists. So if you are a professional, so maybe a doctor, dentist, vet, solicitor, accountant, or even a key worker such as a nurse or a teacher, you may be able to get a professional mortgage. And what that means is you could be offered larger multiples of your salary to purchase your home, and that can be up to 5.5 times. So that is 5.5 times your income. Now, there are minimum earning criteria that have to be met with this particular type of mortgage, and the interest rates you are offered will depend on your deposit contribution, but that is something to look at if you are in any of those professions. Now, the final one I want to mention in this section is the rate reducer mortgage. Now, this is where the property developer can put 3% or 5% of the property price up towards the mortgage over the first few years, and in turn you get a reduced mortgage interest rate, so something like 1% or below, and it's only for that period. It's got its limitations and caveats. So for example, it's only for new build properties, but the property developers and lenders who offer this are also very limited. And the final thing is rates are relatively high. Now, before I go on to the government schemes, I just want to throw out some basic action points for people if you're struggling to qualify on the affordability front. Now, one of the things to do is pay down your debt. Don't open new lines of credit ahead of a mortgage application, and ensure that you are on the electoral register. That is good for your credit report and when you're having a credit check. Do also make sure you check your credit report and take steps to improve your credit. So this is something that can be a long-term plan. You might not be buying a property in the near future, but do check your credit report, look for any mistakes and notify the credit rating agency of those mistakes. You want to do this well ahead of trying to apply for a mortgage as well, because you don't want to be refused because of something that's on your credit report. Another point is to check whether you're financially connected to somebody that will adversely affect your credit rating. Now, that can be seen if you look at your credit report. So you can see, let's say, for example, you've taken out a joint account with somebody in the past. You don't want to be financially associated with them anymore. So you have to make sure that you become disassociated with them, because it could negatively impact your credit report and your ability to get credit if you are still connected. And let's say they're off doing their own thing and racking up huge debts. The other thing is to reduce your regular outgoings. Now, the final thing is, do make sure you go and seek mortgage advice. One of the best tips is to go and speak to somebody well in advance, because they can tell you your likelihood of getting certain products and the options out there, because there are an array of products and new products are coming out all the time. You may be surprised that you might be able to buy your property sooner than you think. And the other thing is, don't think you're wasting their time, because they will see you as a potential client that they will be able to help in the future, so they can help you with your finances in terms of telling you the best things to do in terms of improving your ability to get a mortgage when you want to. Now, the final thing I'm going to go on to is the government schemes. Now, the mortgage guarantee scheme, you may have heard about that. Now, this is an initiative that is really aimed at lenders, so it's not for consumers to worry about. But what it does is it enables or encourages lenders to offer 95% mortgages. So I'm not going to dwell on how it works, but the thing is, it's still around. It's around till June 2025, so it means that there should be plenty of 95% mortgages in the market. Another scheme is the Forces Help to Buy. This allows Forces personnel to borrow up to 50% of their salary interest-free towards a home purchase. Now, there is a maximum £25,000 that can be borrowed. Other schemes for first homes is the first home schemes. This can provide first time buyers with a 30 to 50% discount on their property purchase price. Now, the scheme is limited to new build properties or properties that were previously bought using the scheme. So this isn't available to all homes. So do look out for it, because you may be able to take advantage. And in some areas, the scheme does actually prioritise home buyers who are key workers or members of the armed forces or people who live locally. Another possible scheme for people who are living in a council house or are tenants of the housing association is the right to buy and right to acquire scheme. So you may be able to, if you live in England or Northern Ireland, take advantage of that. So you'll be able to buy the property at a discount. And the final scheme I'm going to mention is shared ownership. And this is where you buy a share of a home from the landlord. And when I say landlord, I mean a council or a housing association. And you pay rent on the remaining share. Now, you take a mortgage out to buy your share of the property, which can be between 1/4 and 3/4 of the home's full value. And then you pay a reduced rent on the share you don't own. But you do have the option to staircase later, which means that you can ultimately buy the portion of the home that you don't own. So these are all options that are available to first time buyers. Do search the Money to the Masses website for full information, as well as all the pros and cons to each. Now, the final thing I want to mention is that we are obviously heading towards a general election, and so there could ultimately be new reforms, maybe to the lifetime ISA. There are people very critical of that at the moment in terms of the penalty if you want to withdraw money early, and also the cap on the value of property that you can ultimately buy. There could be reforms that are announced after the election result is known, and if, for example, we get a new government in place. So do keep an eye out for any changes in the news.
Okay, so let's move on to the second piece of the podcast. Now, there's some news this week, quite disturbing news in some ways, about buy now, pay later firm LayBuy. Now, Damien, we've covered buy now, pay later, and we've talked about the pros and cons of using it. And actually, we're going to quickly, in just a second, jump back to a previous podcast that we did and play out some audio. It's a few minutes long, and then we'll react to that and we'll explain exactly what's happened with LayBuy and the implications of it, if that's okay. So I'll play out the audio now. We'll start with this, and it kind of gives you a bit of an introduction into what buy now, pay later is, and really what the pros and cons are. So we'll listen now.
But the whole thing that is the attraction to people is that it's fee-free and it's interest-free. So they sit there and think, well, why wouldn't I do it? And that's the danger. And it's the only thing I want the message to be on this piece. There's nothing wrong with using different forms of payment, but it shouldn't be the reason why you make the purchase. So how do the companies make money? It's through transaction fees, and they often get a percentage of the amount that you buy. So they earn money basically from the retailer.
Yeah.
But this is where it shows you the psychology behind it, because they've shown that people spend 20 to 30% more if they use the buy now, pay later route rather than just paying for it up front. And of course, for those buy now, pay later companies, that's the whole point, because if they're getting a percentage possibly of the item you're purchasing, the amount you spend, it's in their interest to make you pay more and make it easier. And so the way it works once you've bought it, you don't repay by direct debit like you do with a credit card. It's one of those continuous payment authorities, which is not in itself a bad thing. It's just how companies use them is where the problems arise. So in this instance, it enables the lenders to have more control over actually getting the payment back. I mean, at the end of the day, you're meant to be paying back in installments. If you pay by credit card, you have a bit more control about what you pay and when. And the other thing is that with these lenders, you still have to pay late payment charges as well. And if you don't pay the agreed installments, then it can hit your credit record because they can therefore report it to the credit rating agencies. And so for young people who just buying things because they want them now and they can't afford it, then it could, if they don't pay it, impact their ability to get a mortgage further down the line. When obviously you were talking about years down the line, it could impact them. So that is the issue with it. It's not in itself, like I said, a terrible thing if it's used responsibly. But the one thing I would say to anybody is if the reason that you're buying something is because of the means of payment, buy now, pay later, then you have to bring into question whether it's the right thing to do. So if that wasn't available to you when you're at the checkout, would you have bought the item? If the answer is no, then you probably shouldn't buy it. And there have been a rising number of people who've got themselves into difficulty with this kind of payment offering, and like I say, impacting their credit reports, where they have actually bought things they couldn't really afford and they should have either saved up or not bought the item at all. So the other thing to bear in mind is there's the regulation around this industry is in its infancy. Now, say LayBuy, for example, now they are not regulated according to the BBC when I was reading around the topic, because they don't actually charge you interest, because what they're doing is they're giving you some money and they're making money from the retailer and they're not actually charging you interest. So in that regard, it means that they aren't having to be regulated in the same way. So the FCA has got involved in improving the way some of these companies have operated and the way they made money, etc., which can only be a good thing. In any maturing tech-led industry, it's important that the FCA is involved. But I suppose the other message is, what are the alternatives to this kind of thing? Okay, saving up. But the other one is, I suppose, is 0% purchase credit cards if you do need to make the purchase, but because at least then you can manage the way it's paid back.
And you can budget better as well, right? Because you can set up a direct debit and you'll know you'll be paying hopefully more than the minimum. You'll set up how much you need to pay and pay it off before there's any interest charged. My worry on these continuous payment authorities, if you keep purchasing things, it's hard to keep track of those because you can't, in the budgeting apps, there's nothing to budget for.
Do you know what, Andy?
It's almost hidden.
It's such a good point, because one of the big takeaways when I was looking into, I was researching people who had problems with it and the stuff that was going on around this industry. And the stories that I read were from people who said exactly what you've just pointed out, that it became difficult to manage. It
just
became
keep track of everything.
Just to keep in
know
track.
when it's coming out and how much.
Exactly. It's not that the companies are trying to mislead people. It's just because from a management perspective, it becomes quite difficult. If you've purchased things, you're paying late, and like Andy said, you're not seeing necessarily the payments on your account with a direct debit or whatever it is, it makes it more difficult to manage. And if people are already thinking about buy now, paying later, then there is a suggestion that they probably are struggling with their finances potentially anyway. So I'm not a massive fan of it. I think it's got uses, but just use it responsibly like anything when it comes to credit.
Okay, so there was us talking about buy now, pay later back in 2020 when it was in its infancy, Damien. Now, fast forward to today, we're in June 2024, and LayBuy, who we referenced in that part of the podcast, have gone into administration. Now, the CEO has said that the collapse was down to reduced customer spending, higher credit losses, and increased fraudulent activity. So, I mean, what are your responses to that, Damien, having heard what we heard us say back in 2020 and where we are now with LayBuy?
Well, the first thing is, who are those guys? They seem to know what they're talking about. But it was a good podcast. And there is a part of me that isn't surprised, because I think there's a general thing about buy now, pay later. So this isn't just talking about LayBuy. You've got to also think, in the world that those things, that industry exploded, was a world where credit was cheap as well. So in terms of being able to borrow money to be able to function as a company, it was incredibly cheap to be able to borrow money, because don't forget, even for us as individuals, to take out mortgages was way cheaper. In a world where the cost of credit is much more expensive because interest rates have gone up, that has also impacted the business model of buy now, pay later companies. So I'm not surprised that we've seen such a big news story happen in this industry, and time will tell if it's the only casualty. But the message is also about that the lack of regulation and the CEO's comments. I think it just highlights really some of the problems with this particular industry. Moving on though, for customers, let's just touch upon what it means for people who are customers of LayBuy. Well, the reality is you've still got a debt, and you've still got to pay that debt. Now, the last thing I'd want is people to sit there and think, oh great, they've gone into administration and that means that I don't have to pay. No, you've got to keep paying because you have an agreement with them, and just because they're in administration, the company is still in effect function in the background, and you still have a liability to them. And if you don't pay your debts on time, you will incur those fees, and ultimately if you decide not to pay at all, then it could impact your credit record. So for consumers, you won't be able to take out more credit at the moment with them, but you are still responsible for the credit that you still have. So I just want to finish the piece up really with that warning that I gave in the last podcast that we just played out, that if you are using buy now, pay later, that's fine if you're using it responsibly, and there are plenty of people that do, but it's an area, it's a market that's exploded. We've seen big companies like Monzo, for example, coming into these areas. If you're using it responsibly, fine, but do think about why you're buying something. Are you buying it because of the payment method? And if you are buying it because of the payment method, then I'd argue that that is a bad thing, and you probably should think twice about whether you should be really making that purchase.
Okay, so let's get on with the final piece of the podcast then, Damien. And we're going to be talking about something that occurred earlier on in the week at Manchester Airport, where there were significant delays and flight cancellations through something that was outside of the airline's controls. It was actually the airport itself that suffered a significant power cut. Now, there were people affected on flights going out, flights coming in, and there was also some additional complications with luggage, because there were people who have already boarded the planes, and then the power cut happened. So the plane was able to take off, but the luggage wasn't able to actually get on the aircraft. So there were people arriving in destinations all around Europe, and they didn't have their luggage, and similarly, people coming back and then they weren't able to claim their luggage because the airport sort of baggage carousels weren't working. So it was a bit of chaos that happened at the airport, and as a result there were lots of questions thrown up as to exactly who was responsible and who pays for any expenses incurred, and whether people could claim compensation as well. And also, crucially, where travel insurance sort of fits with all of this as well. So we had a good deep dive into this, and Stella has done a fantastic article which we've put on the Money to the Masses website, and we'll link to that in the show notes, because actually, frustratingly, this is more complicated than it probably should be. So what I'm going to do is go through basically the scenario and what happened, and then people can put their own sort of interpretations into what might happen to them, and where they need to go and how they need to deal with it. So in terms of what happened at Manchester, we're going to focus on UK and EU law, because flights coming out of the UK and airlines that operate in the UK come under that law, and specifically EU regulation EC261. It means that the airline is ultimately responsible for getting passengers to their destination, regardless of the cause for the cancellation or delay. So if we look at that power cut that happened in Manchester, the airline ultimately is still responsible to get the people where they need to get to, and also their luggage. So if your flight departs from the UK or the EU, you are covered under that law. If your flight arrives in the UK or EU, you are also covered under that law. And interestingly, even if your flight arrives from outside of the EU, if the flight operator operates from the UK or the EU, in the case of British Airways, for example, you're still covered under that law. So if you're coming in from Florida with a British Airways flight, you're still covered. So we've talked about the regulations. I'm not going to speak any more about that because it is complicated. So what that means is it's their responsibility to get you to where you're going. So that might involve going on a later flight. It might involve delays. So what else are they then responsible for? So they're responsible to get you to where you need to get to. But of course, if you're sitting around an airport waiting for delayed departures, you might incur food and drink expenses. You might have to stay overnight in a hotel. They are also covered under that ruling as well. So you are covered for what they deem reasonable food and drink expenses, reasonable accommodation costs in a nearby hotel, transport costs to and from the hotel, and also communication costs as well. Now, in some cases, the airline will provide vouchers for you to purchase food and drink, and in some cases, you'll need to provide receipts and claim that back. There are rules in place for what expenses you can claim for and exactly how these apply, and they're based on your flight distance and the delay time. So without again getting into too much detail, I'll give you a couple of examples. If your flight is less than 1,500 kilometers and you've been delayed for more than 2 hours, then you can claim. And in terms of claiming these expenses for your food and drink and potential accommodation costs on these delays, there are different rules based on how long you're flying, i.e. the distance, and it's over 1,500 kilometres, over 3,500 kilometres, for example, and also the delay time. Is it 2 hours, 3 hours, 4 hours, etc.?
As you say, Andy, this covering of expenses does depend on the length of the delay, but also the flight distance that you've got booked, so how far you're going to be travelling. So kind of as a rule of thumb, it seems that if your flight is delayed by 2 hours or more, then you really should be going to speak to the desk, the airline, to find out what their rules and what they do, their procedure for helping you.
Yeah, so ultimately, get in touch with them as soon as you can. As soon as you know you've been delayed, they may be able to do something for you. Even if it's not under the official rules, goodwill gestures and things, get in touch with them. It's a good rule of thumb. Moving on to compensation. So we covered the expenses that you're covered for. And again, they are irrespective of whether it's the airline's fault or not. It's their duty of care to you to do those things in terms of covering your expenses and getting you on the next flight. What can you do in terms of compensation? Now, if your flight is cancelled or delayed as a result and a direct result of the actions of the airline, now these are things like technical problems with the aircraft, delays resulting, say, from overbooking, strike action, this kind of thing, then you can actually claim compensation, a monetary amount, because of the inconvenience, if you like. Now, these are set amounts for set scenarios. So each airline, you will need to speak to them and find out what their sort of claims procedure is and how much they're willing to pay you. We've put some details within the article itself that we'll put links to in the show notes. But to give you an example, if you've been delayed for 3 hours or more and you're flying less than 1,500 kilometres, then you should be entitled to a fixed compensation amount of £220. Now, looking at the compensation amounts, and there's lots of different amounts for different flight times and different distances, you can get anything between £110 compensation up to £520 compensation. So this is an actual fixed monetary compensation amount that you can claim from the airline for your inconvenience.
So presumably those compensation amounts are per ticket. So you've heard of stories of couples who have decided or been asked to take a later flight because maybe flights overbooked, and they've been given money to do that. So this is the compensation that you're referring to, isn't it, Andy?
Yeah, that's exactly right. So let's move on to luggage, because we had the situation in Manchester where the luggage was delayed, and in some cases luggage does get lost. In fact, if you're a fan of the Money to the Masses podcast and you go back into the archives, we did a podcast special about lost luggage and a story of Damien. So there's your homework.
I'll give you the highlight. I went to Barcelona. This was 8-9 years ago. When I went to Barcelona, my luggage turned out it went to Rome, and the luggage eventually came back home separately about 2-3 weeks later. It just turned up on my doorstep. Anyway, yeah, it does happen, and it's happened to me.
So let's look at luggage then, because this is a little bit complicated, because in the situation in Manchester, luggage did get delayed and most of the luggage did arrive ultimately 48 hours later. Yeah, so just to clarify on the lost luggage situation, because it is complicated whether you go through the airline or the travel insurance. If your luggage is delayed or missing, the airline ultimately has 21 days to find and get it back to you. if you get your luggage back within 21 days, you can still claim compensation for delayed luggage. And if it doesn't come back within the 21 days, you have to claim for lost luggage. Now, Citizens Advice have ultimately said if you have travel insurance or home insurance that covers luggage, you're likely better off making a claim through them instead. You'll probably get more money in the long run, and it is an easier process, but you do need to bear in mind that you've still got that 21 days process to wait, and likely your travel insurance company, Damien, you probably experienced this as well, will in the first instance pass the buck back to the airline. So there's going to be this 21-day period where you're going to be going, is it the airline? Is it the travel insurance? You need to weigh up your options. Again, you've got that travel insurance excess cost to consider. And actually, when we looked deeper into this, it's worth noting that even if you get compensation from the airline, it may not cover the true cost of the losses. And I'll give you an example. You might be reimbursed for essentials like toiletries and maybe some clothes as well. But then if you try and claim for additional items that are lost or damaged, they'll probably ask you to provide receipts proving you bought them or that they were in your case in the first place. So a tip here is if you are thinking of going abroad and taking stuff in luggage, if you know you've got the receipt kicking around, make sure it's accessible. I would also recommend taking a picture of your luggage. Open your case. If there's some expensive items in there, take a picture before you actually sort of zip it up and take it with you. That's another way to sort of maybe smooth the process if anything goes missing.
Yeah. And just to add to that, Andy, I mean, it's unfortunate. It happened to me. If you look, the inconvenience of lost luggage is only matched by the effort and struggle to get any kind of compensation from the airline and the insurance company. I can tell you that from past experience. For me, the insurer was trying to pass the buck back to the airline, and it's one of those things that it's going to be a bit of a slog. But like if you mentioned, there is a possibility that you can get compensation if your luggage is delayed or lost.
Okay, so let's move on to the couple of last bits I wanted to cover off in terms of what you can claim for in terms of travel chaos, if you like. There are going to be people who have booked their trip abroad through a packaged holiday, and I just want to cover the various bits and pieces you're covered for in that regard. So if you've booked your holiday as part of a package and there is a cancellation due to unforeseen circumstances that is beyond the holiday company's control, let's say, for example, bad weather, you're still entitled to a full refund of both the flight and the holiday portion. And the same applies if you face significant changes to your holiday, which is actually defined by the Association of British Travel Agents, the ABTA website, as more than a 12-hour delay in a 14-night holiday. So if you're significantly inconvenienced due to something outside of the control, again, bad weather, or more than 12 hours of delay, you can get a full refund. You can, of course, accept something else if they're able to offer you maybe to fly at a later date and provide, basically a replacement holiday. They may offer that as well. So in terms of actual compensation, you won't typically be able to claim compensation via your package holiday provider for delays and cancellations. There is a case for compensation, though, through breach of contract. So ignoring flight delays and cancellations, if you arrive on your holiday and your holiday isn't as you would expect, let's say you've booked a sea view room and you've got a room that's sat opposite a car park, that is slightly different. There are compensation rules in place for that kind of thing. And let's just quickly finish off with package holidays. Let's talk about atoll protection. I'm sure you heard of that. What does that cover you for? That is ultimately a pot, a fund of money that's funded by the package holiday provider that ensures that if they go bust while you're away, that you'll get repatriation home and flights and maybe alternative accommodation if the accommodation is owned by that package provider. And just finally, to round up this piece, then let's talk about travel insurance. We talked about claiming on travel insurance for lost luggage. Many insurance policies also offer what's called delay cover. And essentially that kicks in if your flight is significantly delayed or you miss it due to the connecting flights not quite matching up, or you're waiting to be rerouted. So check to see if your insurance policy covers that. Sometimes in that kind of cover, you won't need to pay excess. Often you will. So just weigh up the costs in terms of whether it's worth claiming on there. Additionally, if you've bought things like airport taxis, additional accommodation for stayovers and things like that, that's where travel insurance can be really good if you've experienced inconvenience and delays through the airlines. So there we go, Damien. It's frustrating that it's as complicated as that, because there are lots of moving parts when it comes to holidays. You've got the airlines, you've got the airports, you've got the holiday providers, and then you've got lots of in-betweeny people. But hopefully we've gone through a list of scenarios whereby people can make sure that they know where they need to go to if they have any problems. And we've also given some tips there, like taking photos of luggage, that people can do to try and preempt any problems coming up.
So as mentioned at the start of the show, there is a fourth piece on this week's podcast, which is exclusive to the YouTube version of the show. So there's a link in the notes if you're listening to this via your podcast feed that you can jump through to the YouTube channel and listen to this next part, or watch the next part, but also like it and leave lots of positive comments. So moving on to the final piece, Andy, I wanted to talk about the child benefit payment delays. Now, if you remember, at the start of the month, there were around about 577,000 families that were impacted by delays in payments due to an error of child benefit. And now the issue was that obviously for some people, the delays would mean that there could be losses incurred, for example, from not paying bills or missed payments of any kind, or going into overdrafts. And so at the time, we did a piece on our social channel, and we also wrote an article explaining to people while it was happening that they could potentially be able to claim some kind of financial redress if they kept evidence of those charges. Now, it's come out this week that HMRC are now finally starting to pay compensation to people that were impacted by this glitch. So if you are one of the families that was impacted by that delayed child benefit payment, then you could potentially get some redress. Now, at the moment, they are paying people up to £50 in financial redress if you can prove that the delayed child benefit payment resulted in a direct financial loss. Now, I'm going to give you an example. That could mean that you went into an unplanned overdraft, which resulted in a charge, say, of £25. Then in this instance, you may be entitled to redress from HMRC, resulting in a payment of £25 to cover that charge. So the financial redress is up to £50. Now, there is potentially an additional compensation amount of up to £50 if you can prove that you experienced distress as a direct result of the delayed child benefit payment. Now, that compensation amount will be assessed on a case-by-case basis. So an example again is that the child benefit payment delay meant that you were unable to buy food for your family, or maybe it's top up your electricity meter. So if you think you've got grounds for a claim, then you need to go to the HMRC website, which I'll put a link in the notes of the show, or you can call them on 0300 200 310, and the lines are open between 8 a.m. and 6 p.m. Monday to Friday. But as I say, we'll put a link to the complaint form on the HMRC website. We'll put that in the notes of this show. So, Andy, that is it. We are done for this week. An unusual show. We had that extra fourth element for those of you who actually watch this on YouTube. All that's left, I think, to say is do please leave us a review. You could win a Money to the Masses mug. I've sent out all the mugs that were owed to people for all the wonderful things they've done to support the show. Don't forget, do review the show. Do follow us on Instagram, YouTube, Facebook group, facebook.com/group/Money to the Masses. Also TikTok. Do like and share everything we do on there. Also, please do go to moneytothemasses.com/podcast, where you will find our page dedicated to this show, where you can find lots of ways that you can support the show. But more importantly, there are lots of deals and offers on there exclusive to listeners of the show. Things like cashback on products and services, particularly financial products and services. So go and look at those. If you use any of those offers or links, then it doesn't impact the amount you pay unless it's obviously a discount, but it does mean that we can receive a small payment that helps support this show and keep it going. So, Andy, I think after all that, all that's left for now is to say until next time.
Until next time.